Top three things in my notebook this morning. Number one, the U.S. dollar. Number two, oil. And number three, the 10-year bond yield. First on the U.S. dollar, obviously this number, the headline number, I haven't gone through it in detail yet, but 321,000 or thereabouts on job ads. That would definitely be good for the dollar. It's bad for oil, and it's probably bad for bond yields in terms of the positioning of the long bond. So just looking at that for what it is within the risk range, obviously looking for a bad jobs number would get you the dollar down. A good jobs number gets you the dollar up. That's how the market's trading. So, again, that's most likely what's going to happen today. The immediate term risk range for the U.S. dollar has the top end of the range just inside of 89.31. So, again, that's where you can go to the top end of the range. Again, the dollar has been well bid for 6 months. I don't think that that'll change today. WTI. Now, the other side of this, don't forget that the Europeans intraday yesterday had to change their memo. So, again, they came out and they disappointed, and then they came back to the market and said, no, we'll give you what you want. We'll give you what you want. So European stocks ripped. The euro started going back down again, and that's what you get on the other side of that is down oil. So now I'm opening up the envelope on the downside price target for oil within the immediate term risk range down to 62.99. The first time I've had a 62 handle on oil. So, again, perversely, you're going to get more and more deflation. So, again, deflationary forces versus people thinking the jobs market's back is most definitely what the bond market's going to have to debate today. So, again, looking at the third thing in my notebook, the 10-year bond yield, the risk range is 2.16 to 2.30. I can get you to 2.33, but, again, this is all within the context of crashing bond yields. Don't forget, we've had multiple times where people have come out and say, hey, look, growth is back. What we're looking for in the fourth quarter is something sub 2% on a year-over-year GDP basis. So, again, that's what the market's most likely going to be trading on. The immediate term has upside pressure to bond yields into the top end of that range. But then, again, you got the deflationary force that is the entire commodity complex, tips and break-evens, et cetera, versus that. So, again, the Fed in their playbook has to deal with both deflation and some job hopes growth. Don't forget that this number is inconsistent with what jobless claims have been doing for the last 4 weeks. So those are your top three things.